Hello, everyone. This is Tom Fox back again with Matt Kelly for another episode of the award winning Compliance Into the Weeds. And boy, do we have a doozy today. I wish I could say we thought it up, but we didn't because, as usual, truth is far stranger than fiction. So, Matt, TD America, TD Bank, TD everything. Where do we begin?
Tom, I have to say, you barely know where to begin with TD Bank. Settled one of the largest AML enforcement actions we've seen in a while with the Justice Department and pretty much every banking regulator in the United States. They did that last week, where, let me see if I remember it all correctly, they had a $3 billion in various penalties. They had corporate plea agreement. They pleaded to guilty to conspiracy to commit anti-money laundering violations or to willfully fail to maintain an effective anti-money laundering compliance program. They will have two different compliance monitors, and they have an extensive list of compliance reforms they need to make, of which TD Bank says it has started to make some of those reforms, still a long way to go. And then the real kicker that should get board directors' attention everywhere is that the federal banking regulator, the Office of the Comptroller of the Currency, they clamped a asset cap on TD Bank. Its total assets cannot exceed more than $434 billion, which was the amount of total assets it had as of September 30th, its most recent quarterly report. And if they do not make the necessary compliance improvements in a timely manner, OCC reserves the right to ratchet that cap up by another 7% or ratchet down. I'm not sure, but picture a choke collar on the bank getting tighter and tighter the longer it takes to make its compliance improvements. And Tom, we've been talking now for what, 3 or 4 minutes. We haven't actually gotten to any of the nutty stuff that TD Bank did, which is a podcast unto its own right, but there were no less than three separate criminal gangs using their weak anti-money laundering controls to launder a total of $670 million through the bank in the 2010s, all the way up to as late as April of this year. Stuff still going on, and the huge amounts of transactions that were not examined by TD Bank. There was one of the three schemes involved several employees in the bank who were working with drug cartels in Colombia to launder money there. There was human trafficking. There's all sorts of scams going on. It is an astonishing case from soup to nuts. And there is a ton of stuff compliance officers could learn here.
Matt mentioned a couple of figures there or numbers without the figures when he said lots of verified trades or transactions. That was 18 trillion plus in transactions. This was not a 20-year-old case. This was not a 10-year-old case. As Matt said, it went up to April of 2024. That's how long the money laundering was going on. The drug cartel case, or the cartel component of this, was over $500 million in money laundered through TD Bank. The sums here are just sort of beyond belief. I hate to put guardrails around anything that you and I would ever do, but there's so much here to talk about. Maybe we could on this podcast focus on the penalty because you laid it out on the, I'm going to call it compliance in bondage
Yes.
penalty, or the bank perhaps in bondage for those purient folks out there amongst us, and think about that collar and what it might mean. Nevertheless, this is the first time we've seen a potential reducing profitability of an organization. We saw Wells Fargo, the OCC slap a growth penalty on them. But here, as you said, it's for several years and it can become increasingly tight. What do you make of the OCC implementing that type of penalty? Is it because of the seriousness of the violations? Is it because they don't think the board is really committed to this, or maybe something else?
I think that there are a couple of things to keep in mind here is the OCC has clearly stepped up its enforcement attitude lately toward the big banks. Um, TD Bank is, I believe, the 10th largest bank in the country. So it is not in the top tier with Wells Fargo and Citibank and JP Morgan, but it is definitely captain of the junior varsity team. It's not a small bank, But what OCC has really been doing with several different large banks over the last 6 months or so is leaning on them to do better at improving their compliance programs in a timely manner. Just to give you some history, earlier this summer, first, OCC sanctioned Citibank a second time with a $137 million penalty for failing to make improvements promised in a prior enforcement action from 2020, where Citibank had been fined $400 million, still hadn't done enough in the 4 years. So OCC slapped them around again. Tom, you mentioned Wells Fargo with the asset cap that came in 2016, where they capped Wells Fargo's assets at 2 trillion, and it is still in effect today. Wells Fargo just filed its most recent quarterly report last week, and its total assets are $1.996 trillion dollars, and it's been there pretty much for the last 8 years. But OCC also brought a separate follow-up enforcement action against Wells Fargo just a couple of weeks ago, where in addition to that asset cap, they have put a restrictions on new products that Wells Fargo might offer until it also steps up the pace of its compliance program improvements. And now finally, we have this haymaker punch that they have thrown at TD Bank with the asset freeze and the ability to ratchet up that asset freeze by 7% increments. I'm not sure exactly how often they can do it, but even just ratcheting it up just once in over the course of, say, a year, I think it's a 3-year improvement program they have. I don't know when that ratcheting might be able to happen, but clearly this is going to be a sword hanging over TD Bank's head, and it is meant to get them to get with the program and improve their AML compliance. For those not in banking who aren't entirely sure about the significance of an asset freeze, for banks, this is a big deal. If you cannot grow your assets over time inexorably, you will have diminished earnings capacity, which will then affect things like CEO bonus payments, board payments. The value of the stock is going to go down. If you wanted to acquire a bank, first off, I'd die of surprise if OCC would allow that at all. But typically, if you want to acquire a bank, you might try to use some of your assets to help finance that deal. That kind of stuff gets more difficult. Everything gets more hard for a bank if you have an asset freeze and you can't expand your assets. So this is like a big slap to the board and to senior management at TD Bank that you got to get with this and you got to get with it fast. That is exactly the message OCC gave here. And we haven't even gotten into the other penalties from the Justice Department about the guilty plea and the criminal fine and the $3 billion fines. I know OCC did impose part of that $3 billion. There's so many people involved here, so many agencies. I'm not sure who was fining TD Bank what portion of the $3 billion, but this is just a crushing enforcement action.
1.8 billion from the Department of Justice. I read through how they calculated the fine today as part of my research for this podcast. The remainder comes from the Fed, the OCC. Matt, you mentioned that there may be other regulators out there we didn't hear from. I immediately thought of the Department of Financial Services of the state of New York, where TD Bank has an office. TD Bank is the 10th largest bank in the United States, 30th worldwide. And then it's also a publicly listed company, which means the Security Exchange Commission has oversight over it. I don't know if it's domiciled in Delaware, but if it is, I can certainly smell a Caremark claim coming out of this. So there may be additional regulatory scrutiny from other regulators who have other interests here. I think we ought to explain why this was so pervasive. And this topic you really hit on your second blog post that went up today. So maybe we could spend a little bit of time about tone at the top and how high up this whole scheme, scam, and conscious indifference went.
Yeah, the Justice Department's indictment against TD Bank really called this out. Is that the senior most levels of the bank, all the way up to the US management here, and I presume all the way up to the board of the parent company in Toronto, because TD is Toronto Dominion, they had a conscious strategy of simply not raising the budget. That was it. That was the strategy. To make more money, we will not raise the budget. And they actually had a name for that. It was called, let me just make sure I have it right, the flat cost paradigm, also known as the zero expense growth paradigm, which, of course, we all know what that really means is just you don't get any budget increase. And that went on for year after year. For example, and this is all detailed in the Justice Department indictment, the global AML team's expenditures on the US anti money laundering program. By the year 2021, those expenditures were less than what the bank was spending on US anti money laundering in 2018, even though at the same time, the US assets at TD Bank, they jumped 34% up to 559 billion. US net income went up 19% to 4.98 billion. It's not like the US division was not generating free cash to be able to do this. Yes, they were, but management had said, no, we will not be increasing the budget. While they kept their AML budget flat, business exploded. And so everybody knew that the bank's anti money laundering program was overworked, under resourced. And so criminal gangs flocked to it. And to my thinking, that is really part and parcel of what the Justice Department has been talking about really for years. Do you have a strong tone at the top? Do you take a culture of compliance seriously? If your whole strategy is not to increase the resources to your risk management functions, including compliance, while the business is growing, by definition, those resources, those risk control functions, they're going to fall out of alignment with what the risk actually is. And they're going to become weaker and more antiquated. And we could talk about exactly how antiquated they were with the 18 trillion in transactions that were not monitored. I think that was about 92% of all transactions flowing through the US branches were not being monitored. But really, if that's your strategy, what else did we think was going to happen here? Sooner or later, inevitably, the ability to have a strong compliance function would wither and atrophy away. And that's exactly what happened. In fact, Tom, it is quite telling that the chief anti money laundering compliance officer during this time in the 2010s, he himself said in his self evaluations that he was proud that he could embrace the zero cost paradigm strategy. Like he was part of this. He was one of the people who thought this was going to be a good idea. And clearly it is not. But if you get back to why did the Justice Department decide to bring a criminal charge against the company and force them to plead guilty? Because the whole strategy of how TD Bank was going to develop and grow and make more money was to not invest in the risk control functions. I mean, that's just a conscious choice. They intentionally underfunded their AML program. And so all these criminal opportunists rushed in to take advantage of it. And that was known. The TD Bank employees themselves talked about how the AML program was a joke. And so I think that more than anything else is really the big takeaway here is how you can have a corporate strategy that is just divorced from the reality that you need to care about compliance risks. And this is the sort of consequence that can happen. And I'll sum it up with one final quote from Nicole Argentieri, who is the head of the criminal division at the Justice Department. In one sentence, she summed up the whole case here. For nearly a decade, TD Bank failed to update its anti money laundering compliance program to address known risks. Period. That's it. That's the whole case. And that's why they wound up with this horrendous problem and this huge settlement that they had.
Now, the other thing that struck me was not only was there conscious indifference at the literally the highest levels of the US corporation and the parent, they had actual knowledge of the deficiencies of the program. There were 2 OCC enforcement actions, one in 2013 and one in 2018, which found the bank's AML and BSA programs insufficient. And OCC reported that to the board, and the boards, of course, had to sign off on the settlements. But as Jonathan Marks is wont to ask, where was internal audit? Internal audit flagged the deficiencies and reported those deficiencies up. We had third party consultants who were flagging the deficiencies and reporting it up. We even had some compliance personnel trying to put new technology in, and it was not supported because, of course, it cost money. So this is as close to maybe, I don't know if it's Siemens creating an entire corporate structure or Odebrecht creating an entire corporate structure to evade or to pay bribes, but this is really close to complete conscious indifference or actual knowledge at the highest level of an organization. And I've been struggling with what's the role of the regulators? Does the world need the 30th largest bank or the 10th largest bank in the United States? Do we need a place that's not going to foster $500 million in money laundering? Is this penalty going to be sufficient? How do we even begin to think through questions at a scale of basically fraud at this size?
I mean, that's such a large philosophical question. The short answer is I don't know. In future writings about this, I'll be doing a post taking a look at more specifically what OCC has directed TD Bank's board to do. The board must undergo some reform. I don't know that they need to reconstitute themselves with new board directors. Maybe they already have brought in new board directors, but TD Bank did say that, or the OCC said TD Bank must have now a dedicated compliance committee. That is much the same as what we've seen with previous OCC enforcement actions against large banks lately. But I mean, they are going to babysit and peer over the shoulder of TD Bank for years. There is going to be an in house compliance consultant, which I think is one of the two monitors, not to be confused with the Justice Department monitor. But this person is going to live rent free in TD Bank's senior councils for at least 3 years. They are going to peer over everything that TD Bank does. They're going to review new product lines. This is going to be a real curtailment of TD Bank's ability to innovate and improvise and grow until finally the board and senior management understand you can't do any of that. You can't do any innovation or growing or prospering in unless you're doing it in a risk aware manner. And the only way you can do that is the more the organization grows, the more complex its risks, the more you need to fund the risk management control functions there. And compliance is one, internal audit is another. At banks specifically, they have a risk management function separate from compliance and goes on and on. It really is just, it's astonishing to see that this was an embedded culture of I don't want to go necessarily to say as far as a culture of wrongdoing, but a culture of disregard for right doing. They clearly could not care less that they were unable to make sure TD Bank was going down the right path. The whole path to growth was predicated on not paying attention to are they doing the right thing. So that really is just what stuck out to me is just the callous culture of disregard there.
Matt, when we were visiting before we went on camera today, you thought or talked about rather some of the things we both read in the 2024 update to the evaluation of corporate compliance programs as requirements for both corporations and compliance professionals. Maybe talk about what you saw in that document as juxtaposed with the failures at TD America and the solutions the regulators have mandated.
It's striking when you look at what the Justice Department said several weeks ago with its updated compliance program guidelines. So they had added a new section about resource allocation. And there are several questions now that prosecutors need to be asking when they are evaluating a compliance program. I'm just going to read them out. How do the assets, resources, and technology available to compliance and risk management compare to those available elsewhere in the company? Is there an imbalance between the technology and resources used by the company to identify and capture market opportunities and the technology and resources used to detect and mitigate risks? That is so on point for what TD Bank did not do and where they went wrong that I actually wonder if the screw ups at TD Bank and their lack of investment in compliance technology, did that inspire the Justice Department to add this in? Because you can't get more on point and relevant to what TD did wrong than those two questions I just read off. It is really striking. But they clearly, if you read through the indictment and all the press conference quotes and the statements, and I think even the Attorney General himself made a statement about this. I know the Deputy Attorney General did, and the U.S. Attorney in Jersey who brought the case, and the head of the criminal division. Everybody's making statements at the Justice Department. They care about this a lot. And they talked clearly and expressly and multiple times about how the management at TD consciously decided we are not going to give compliance enough resources. And the risks and the business boomed right along, but the risk management control functions were left behind in the dust. And Justice Department hit the roof over that. That is the message I would take if I were a compliance officer to my CFO at budget season, to my CEO, to the board, anytime you have a chance to, and they ask, so what's going on? This is what's going on is a bank's board and management are getting crucified for not resourcing the compliance team sufficiently. Print that out and staple it to the board's forehead because apparently some boards at some very large companies are still not getting that message. And that's that.
I can't think of a better way to end this podcast than on that. So, Matt, we'll be exploring this down the road.
Thank you, Tom.